The stock market is more complex than you think. If you have already studied the basics of the stock market, then that is great. However, there's still information about the stock market that you probably didn't know. During the pandemic, interest in the stock market has increased dramatically. With the COVID-19 restrictions, lockdown policies were implemented worldwide. This has caused people to find other ways of investing while staying at home. The stock market has been found to be one of the top investing areas during the pandemic. It also caused more beginner investors to flood the stock market. You might have missed out on essential stock market knowledge as a beginner stock trader. Do you know that there are three different types of stocks? Aside from having a stock, there are various benefits of holding a stock, which we will talk about in this video. Welcome to Fun Rebel channel. Today, we will talk about money and finance. And if you're new to this channel, then hit the subscribe button below for more life hack content. A stock is not just a stock, but let us talk about what a stock is first. Stocks are shares that you can buy from a company to be a part owner or shareholder. It is like having a piece of an enormous cake. You get to have and carry the benefits or the risks. There are different types of stocks. It is divided into three: common stocks, preferred stocks, and restricted stocks. So what makes them different from each other? Common stocks. For starters, they are the most common ones. They are the most sold and bought at any stock market exchange. The benefit of having a common stock is that it gives the shareholders the right to elect the board of directors and have a say on company policies. Money can define your voting power. The standard ratio is 1 share to 1 vote. So if you have many common stocks, you have more say in the company's decisions. Preferred stocks. Preferred stocks have their pros and cons. One of the pros of owning preferred stock is that it is less risky than common stocks. If the company goes down or goes bankrupt, preferred stock shareholders have an advantage. They can claim company assets to compensate for their investments. They are prioritized first before common stock shareholders. Another good quality of preferred stocks is that its price is not dependent on the stock market. If the common stock price declines, the preferred stock price will still stay the same. They provide fixed dividends to stockholders, and as you may have guessed, they issue dividends to preferred stockholders first before common stockholders. It looks like common stockholders are at a disadvantage, right? Well, not really. Regarding cons, preferred stockholders have no say in the company's decisions and policies. They have no voting rights. Since the price of preferred stocks does not depend on the stock market, it has limited potential growth. Preferred stocks have a stable value. Thus, it always misses on stock market growth. Preferred stocks are best for people who are looking for stable and secure income. These people are nearing the retirement or are in retirement age. When interest rates decrease, prices of preferred stocks increase and vice versa. Restricted stocks. These types of stocks are those given to the company's higher-ups, like executives. They serve as a compensation or benefit for the work they are doing for the company. The downside is that these stocks cannot be easily bought or sold without the go signal of the SEC or Securities and Exchange Commission. To explain it further, let's use this as an example. You are the executive of the company. You are given 10,000 restricted shares. It means you cannot use or sell it unless you have the right to it. That is what you call vesting. Vesting means that you already have ownership of the stocks given to you. Being able to vest will depend on the conditions of the company or provider. Most of the time, restricted stocks have been used as an incentive to good-performing company employees. Initial public offering. You may wonder, what is the difference between this and typically selling stocks? Initial public offerings are the first time a private company turns public and sells stocks to anyone interested. The main reason why companies go public is that they need to raise additional capital. They produce more stocks that the public will buy. That money will then be used as capital for company expenses like product development. However, it becomes a bummer for owners and investors before the companies go public. For example, 5 people have the same amount and percentage of shares. If there are 50 shares, each has 10 and 20%. Now the company produced 10 more shares for the IPO. The total shares will now be 60. So 10 shares will not equate to 20% anymore, but it decreases to 16.7% each. If you are an investor in the company, this doesn't sound good, right? Well, they agree and still do it for some reason. The first is for the company to grow. The IPO's funding will help the company grow, thus still making the decreased shares more valuable. The second is to create liquidity for the company. It will help them be able to exchange their shares for the money. There's a catch though. Investors before the IPO cannot sell it yet. They have to wait for the lockup period to end before they can easily sell their shares for profits. It becomes one of the reasons why stock prices dip because the lockup period is ended. Investors are selling their shares to take profits, thus creating heavy selling pressure. Second public offering. It mostly happens after the IPO is done. Just like what they do in the IPO, they produce more stocks to sell again for funding, which will be used for whatever reason the company needs. It still decreases the value of previous shares that existed before it. Also, it reduces the value of earnings per share, or EPS. EPS are earnings the company is getting after paying out dividends. To know the exact value of EPS, you need to subtract the dividends from the profits and divide it by the total number of shares. EPS can help you decide on what are the best companies to invest in. Let's use this as an example. Company A and B both have a stock price of $20. Company A has a profit of $600,000, pays out $100,000 in dividends, and has a total of 50,000 shares. Company A's EPS will be $10. On the contrary, Company B has a profit of $1 million, pays out $100,000 in dividends, and has a total of 120,000 shares. Company B's EPS will be $7.5. Even though Company B has more profit, Company A still had the better EPS. P over E ratio. The P over E ratio will help you understand and estimate whether the stock's price is overvalued or undervalued. It tells investors the worth of the company. Let us reuse the example again earlier. If the price of Company A's stock price is $20 and EPS is $10, 20 divided by 10 is 2. Company A has a 2 P over E ratio. It means that the stock price is trading 2 times its earnings. While Company B has a stock price of $20 and EPS of $7.5. 20 divided by 7.5 is 2.7. Company B has a 2.7 P over E ratio. The stock price is trading 2.5 times its earnings. Remember, the higher the P over E ratio, the more overvalued the company is, while the lower P over E ratio means the company is undervalued. An overvalued company is not a good sign at all. It looks like Company A is a better choice in this case. Dividends. Dividends are earnings that are distributed among shareholders. To know how many dividends you will receive, you need to divide the total allocation of dividends by the total number of shares. For Company A, $100,000 is divided by $50,000. It equates to $2 per share. If the share price is $20, you will receive 10% in dividends yearly. For Company B, $100,000 is divided by 120,000 shares. It equates to 83 cents in dividends. If the share price is $20, you will receive 4.15% in dividends per year. It looks like Company A is a better choice for this case as it gives out higher dividends. Now that you know the indicators you have missed, you can make better investment choices. Make sure to choose which one will fit best according to your preferences. Again, this is Fun Rebel. Thanks for watching. If you like this video, please click the like button, and if you want to upgrade your life from what you have to what you deserve, click the subscribe button now.